trading is not what you think. Every day, millions of people think they're going to make quick cash by jumping into the market. But here's the shocker: 90% of traders lose money in their first year. That's right. 9 out of 10 people who try trading end up losing everything. But what if I told you that you don't have to be one of them? What if you could avoid the mistakes that trap most traders and actually build real wealth over time? In this video, I'm going to break down the truth about trading, the myths, the facts, and the strategies that actually work. You'll learn why most traders fail, what the pros do differently, and how to spot manipulation in the markets. I'll show you how to protect your hard-earned cash and trade with confidence. Ready to get real about trading? Let's dive in and uncover the truth behind the charts. Chapter 1. The Trading Mirage. Myths you've been sold. Trading has a way of attracting dreamers. The internet is full of promises. Make $1,000 a day, or turn $100 into $10,000 in a month. These claims are everywhere. But here's the hard truth: 90% of traders lose money in their first year. The hype hides the harsh reality. The first myth? That trading is quick and easy. Many assume you can buy low, sell high, and cash out. It sounds simple, right? In reality, markets are unpredictable. Even the best traders win only about 50–60% of the time. The key is not winning every trade but managing losses. Let's bust another myth: you need to trade every day. Day trading is popular online, but it's not for everyone. Studies show that most retail day traders earn less than minimum wage after accounting for fees and losses. Instead, successful traders focus on quality over quantity. One good trade can outperform dozens of bad ones. And then there's the belief that you need to predict the market. Legendary trader Jesse Livermore once said, "It was never my thinking that made the big money for me. It was always my sitting." This means patience and timing matter more than constant action. Rather than guessing the next market move, learn to wait for the right setup. Chapter 2. The Secret Sauce of Pro Traders. So, what's the secret? It's not fancy indicators or insider tips. It's discipline. Professional traders follow strict rules to guide their decisions. Without a plan, you're gambling, not trading. One core strategy? Risk management. Pro traders never risk more than 1–2% of their total account on a single trade. Why? Because losing streaks happen. Imagine losing 10 trades in a row. If you risked 10% each time, you'd wipe out your account. By keeping risk small, you live to trade another day. Another powerful tool is the R ratio, risk to reward ratio. Let's say you're risking $100 on a trade. A solid setup should aim for at least $300 in potential profit. That's a 1–3 ratio. This way, even if you lose more often than you win, you can still be profitable. Pro traders also focus on trends. A famous saying goes, "The trend is your friend until the end." Trying to trade against the market's direction is like swimming upstream. It's exhausting and rarely works. Instead, look for clear trends and trade with the flow. Then there's the power of journaling. Top traders track every trade they make. Why? Because reviewing your mistakes is the fastest way to improve. Data from the CME Group found that traders who journal outperform those who don't by as much as 20%. Finally, professionals know the value of staying calm. The market can be chaotic, but your emotions shouldn't be. Warren Buffett famously said, "The stock market is a device for transferring money from the impatient to the patient. Staying level-headed gives you an edge." Chapter 3. Market Manipulation. Are you the pawn? Here's a truth no one talks about. The market isn't always fair. Big players, like hedge funds and institutions, control much of the action. They use strategies like high-frequency trading, HFT, to profit from small price changes in milliseconds. Retail traders can't compete with that speed. Take a look at stop hunting. Have you ever placed a stop loss, only to see the price hit it before reversing in your favor? That's no accident. Large players often manipulate prices to trigger stops, buying low or selling high at your expense. The lesson? Don't set obvious stop-loss levels. Hide them just outside major support or resistance zones. Then there's news-driven trading. Institutional traders often have faster access to breaking news. But here's an insight: the market often overreacts to news. A bad earnings report might cause a stock to drop 10%, but it often recovers part of that loss within days. If you stay patient, you can profit from these overreactions. Another key point? Liquidity. Big players move markets, but they can't do it alone. They rely on retail traders to provide liquidity. When you buy or sell impulsively, you're feeding their profits. Instead, trade where the liquidity is high, like during market openings or key announcements. Lastly, let's talk about the pump and dump schemes. These often target small-cap stocks or cryptocurrencies. The scheme involves hyping up an asset, causing its price to skyrocket, only for insiders to sell off and leave everyone else holding the bag. Be skeptical of hot tips or viral trends. If you're finding this information helpful, make sure to subscribe and hit the notification bell. You don't want to miss the next chapters, where we dive even deeper into trading success strategies. Chapter 4. The Psychology Trap. Your worst enemy is you. When it comes to trading, your mind is often your biggest hurdle. It's not just about charts and numbers, it's about emotions. Fear, greed, and impatience can ruin even the best trading plan. Let's start with fear. This usually strikes when trades move against you. Imagine entering a trade, and within minutes, it's in the red. Panic sets in, and you close it. Later, you see the price reverse and hit your target. Sound familiar? This happens because fear clouds judgment. The solution? Trust your plan. Data from the book, Trading for a Living, shows that disciplined traders perform 30% better than those who constantly second-guess. On the other side of fear is greed. This emotion makes you hold onto trades too long, hoping for more profits. Studies by the Journal of Behavioral Finance found that traders who let greed take over lose an average of 15% more than those who follow preset targets. To avoid this, stick to your exit plan. A profit booked is a profit secured. Another psychological trap is FOMO, fear of missing out. You see a stock skyrocketing and feel the urge to jump in. But by the time you enter, the momentum dies, and you're left with losses. As billionaire trader Paul Tudor Jones says, don't focus on missing out. Focus on not blowing out. Finally, let's talk about overconfidence. After a few wins, it's easy to think you've mastered the market. But overconfidence often leads to bigger risks and, eventually, bigger losses. Remember, even the best traders don't win every time. George Soros once said, "It's not whether you're right or wrong. It's how much money you make when you're right and how much you lose when you're wrong." To manage emotions, use tools like trading journals and self-checks. Ask yourself, am I trading because of a plan or because of how I feel? Staying aware of your emotions is half the battle. Chapter 5. The 80-20th rule of trading success. Did you know that 80% of your trading results often come from just 20% of your actions? This is the Pareto principle in action, and it's true in trading too. The first step is identifying your high-probability trades. These are the setups that work most consistently for you. For example, if you find that breakout trades work better than trend reversals, focus on those. A study by the London School of Economics found that traders who specialize in one strategy outperform generalists by 40%. Efficiency is key. Don't waste hours watching every stock. Use screeners to filter opportunities. Tools like Finviz or TradingView can help you find setups in minutes. Time is money, and efficiency pays off. Next, let's talk about trading times. Most market action happens during the first and last hours of the trading day. According to the NYSE, 50% of daily volume occurs during these windows. Focusing on these periods can save you time and boost results. Also, remember the importance of letting winners run and cutting losers quickly. A famous quote by trend trader Ed Seykota explains it well. The elements of good trading are 1. Cutting losses, 2. Cutting losses, and 3. Cutting losses. Automation can help too. Use stop-loss orders and alerts to manage trades without constant monitoring. This reduces decision fatigue and keeps you from overtrading. Lastly, measure your performance. Are 80% of your profits coming from certain setups or specific times of the day? Focus on these strengths. The more you streamline, the more effective you'll become. Chapter 6. Beyond the charts. Building true wealth. Trading can create income, but true wealth comes from how you manage that income. It's not just about making money, it's about growing it wisely. One key strategy is diversification. Don't put all your trading profits back into the market. Instead, spread them across other investments. Warren Buffett recommends keeping a mix of stocks, bonds, and other assets. This cushions you during market downturns. Another overlooked tip? Build an emergency fund. Even the best traders face losing streaks. Having 3-6 months worth of expenses saved can keep you afloat during tough times. You should also think about tax efficiency. Did you know that active traders often pay higher taxes on short-term gains? Consider holding some investments longer to qualify for lower tax rates. A financial advisor can help you structure this wisely. Don't forget about leveraging your profits. For instance, you can reinvest trading gains into real estate, dividend-paying stocks, or even a side business. These create multiple income streams, reducing your reliance on trading alone. And finally, focus on the long term. Legendary investor Charlie Munger said, "The first rule of compounding: never interrupt it unnecessarily." This means avoiding unnecessary risks that could wipe out your gains. Trading is just one piece of the wealth puzzle. By thinking beyond the charts, you can turn short-term profits into lasting financial freedom. Thanks for sticking with me to the end. Don't forget to subscribe, like, and hit that notification bell for more trading insights and tips. Together, let's make your trading journey a success.